Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'm excited to share today's stories with you. We're starting off with a look at the latest earnings reports from some of the biggest players in the industry. Eternal, a company that's been making waves in the market, has just released its quarterly results, and the numbers are impressive. With growth close to 130%, it's no wonder the stock is getting attention from investors. But what does this mean for the broader market? Is this a sign of things to come, or is it just a one-off? We'll also be discussing the banking sector where ICICI Bank and HDFC Bank have reported strong numbers. But not all banks are created equal, and we'll be exploring how the smaller players are faring in comparison to their larger counterparts. Is it true that the big banks are getting bigger, leaving smaller ones in their wake? To help us make sense of it all, we'll be hearing from market expert Anshul Saigal, who will share his insights on the current state of the market and what investors can expect in the coming months. With his expertise and our analysis, you'll be better equipped to navigate the ups and downs of the stock market. So, let's take a closer look at these stories and what they mean for your investments. We'll be examining the numbers, the trends, and the expert opinions to give you a comprehensive view of the market. And as always, we'll be asking the tough questions to ensure that you have all the information you need to make informed decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into our middle segment. Today, we're discussing a fascinating topic that has been making waves in the financial world. You might have heard about the recent changes to superannuation laws in Australia, and we're here to break it down for you. The new laws propose to tax earnings from super balances above $3 million at 30%, up from the current 15%. This change is expected to affect around 1 in 200 Australians, but critics argue that many more people will be impacted in the coming years if the threshold isn't tied to wage growth or inflation. To give you a better understanding of who might be affected by this change, let's look at some numbers. According to research from the Australian Tax Office, about 77,400 individuals have super balances between $3 million and $10 million. Around 7% of those affected have balances between $10 million and $50 million, while a tiny fraction, less than 1%, have nest eggs exceeding $50 million. It's also interesting to note that the majority of people with super balances above $3 million are older Australians, with around 65% classified as retirees. Most of them live in affluent areas within major cities, such as Sydney's eastern suburbs or Melbourne's inner areas. Now, some groups have raised concerns about the potential impact on farmers and those living in rural areas. However, the data suggests that only a small percentage, around 7%, of those affected live in rural areas, and not all of them are involved in farming. As with any policy change, there are valid arguments on both sides. On one hand, the government argues that this change will raise around $2.7 billion in revenue and help reduce the budget deficit. On the other hand, critics argue that it could unfairly penalize those who have worked hard to build their superannuation saving. At the Riskwiser Zone, we strive to provide you with balanced and unbiased information. We encourage you to consider multiple perspectives and make informed decisions about your own financial situation. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. Today, we've been exploring the world of investing and risk management. As we wrap up this episode, I want to leave you with some valuable insights from a market veteran, Nilesh Shah, the MD of Kotak Mahindra & Co. In a recent interview, Nilesh shared his expertise on how to build wealth through systematic investment plans, or SIPs. He emphasized the importance of starting with SIPs, especially for new investors, as it helps them navigate the market's fluctuations and develop a disciplined approach to investing. Nilesh also cautioned against one of the most common mistakes even seasoned investors make: letting ego get in the way of their investment decisions. He reminded us that controlling our ego is crucial in maintaining a balanced portfolio and avoiding costly mistakes. To drive this point home, Nilesh shared an inspiring story from the world of cricket. He recalled how Kapil Dev's Indian team faced a crushing defeat, only to bounce back and win the match. The lesson here is that even when our portfolio seems to be collapsing under pressure, we must remain calm, reassess our strategy, and make adjustments as needed. As Nilesh put it, Hausla hoga toho yayega. With determination and perseverance, we can overcome any obstacle. So, the next time you're faced with a market downturn or an investment setback, remember Kapil Dev's advice: Dekling. Let's see what happens next. In conclusion, building wealth through SIPs requires discipline, patience, and a willingness to learn from our mistakes. By starting with a solid foundation, controlling our ego, and staying adaptable, we can navigate the complexities of the market and achieve our long-term financial goals. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.